Do you know that most of your financial decisions are made by a part of your brain that is fast, emotional, and almost entirely wrong about risk? That the part of you that feels certain about an investment, that acts on instinct, that panics when markets fall, is the same system that evolved to help you escape predators on the African savannah, and that it is spectacularly poorly designed for modern financial markets. This is what Daniel Kahneman spent his career proving, and what his work means for anyone who wants to build and protect wealth. This video is for educational and informational purposes only and does not constitute financial advice. Chapter 1. The Man Who Changed Economics. Daniel Kahneman was born in Tel Aviv in 1934 to a French Jewish family that had fled the rising Nazi threat in Germany. He spent his childhood in France during the German occupation, an experience that shaped his thinking about human irrationality in extreme circumstances. He emigrated to Israel as a teenager and completed his undergraduate work there before earning his PhD in psychology from the University of California, Berkeley, in 1961. He spent most of his academic career at the Hebrew University of Jerusalem, where he met Amos Tversky, the collaboration with whom would define his most important work. Kahneman and Tversky were an unusual pair. Kahneman was cautious, rigorous, prone to self-doubt. Tversky was bold, confident, and aggressive in his intellectual claims. Together, they produced a body of work on human judgment and decision-making that fundamentally challenged the prevailing model in economics, the model that assumed people were rational. For most of the 20th century, mainstream economics was built on the assumption of Homo economicus, economic man, a being who makes decisions by rationally assessing costs and benefits, who has stable and consistent preferences, and who processes information accurately to arrive at optimal choices. This was not a description of how people actually behaved. It was a simplifying assumption that made mathematical modeling possible. Kahneman and Tversky's work documented in rigorous experimental detail the systematic ways in which actual human decision-making departed from this model. They were not the first psychologists to note that people were not perfectly rational, but they were the first to map the irrationality systematically, to show that it was not random noise, but predictable, consistent patterns of error. In 2002, Kahneman was awarded the Nobel Memorial Prize in Economic Sciences for this work. Unusual for a psychologist. Tversky had died in 1996 and was therefore ineligible. But the Nobel Committee's acknowledgement of Kahneman's work was an acknowledgement of the field Kahneman and Tversky had together created: behavioral economics. Kahneman died in March 2024 at the age of 90. Chapter 2. Two Systems. Thinking, Fast and Slow was published in 2011 and is Kahneman's attempt to summarize for a general audience what decades of research in psychology and behavioral economics had established about the human mind. The book's organizing framework is the distinction between two systems of thought that Kahneman calls System 1 and System 2. System 1 is fast, automatic, effortless, and largely unconscious. It is the part of your thinking that recognizes your mother's face in a photograph, understands the phrase bread and butter without effort, and flinches when someone suddenly raises a hand near your head. System 1 operates continuously and produces a steady stream of impressions, intuitions, and feelings, the background hum of mental activity that underlies all conscious thought. System 1 is excellent at the things it evolved to do. It recognizes patterns quickly. It responds to immediate threats without requiring deliberation. It navigates familiar social situations with minimal effort. In the environment in which human cognition evolved, a social, physical environment in which quick responses to familiar situations were survival relevant, System 1's characteristics were advantageous. System 2 is slow, deliberate, effortful, and conscious. It is the part of your thinking that does long division, fills out a tax return, or follows a complex logical argument. System 2 requires attention, uses mental energy, and can only handle one thing at a time. When you use System 2, you are aware of thinking. In Kahneman's framing, System 2 is also lazy. Because it is effortful and limited in capacity, it tends to step back and let System 1 handle situations whenever System 1 seems adequate. The default is fast, automatic, effortless thinking. Slow, deliberate thinking is invoked only when necessary. The problem, and the central insight of Kahneman's work, is that System 1 is wrong, in predictable ways, about exactly the kinds of questions that matter most for financial decisions. Questions about probability, questions about future value, questions about risk and return, questions about what decisions will actually make you happy. These are all questions that require the kind of slow, statistical, evidence-based analysis that System 2 is designed to do. And System 2, being lazy, often doesn't do it. Instead, it accepts System 1's confident, fast, emotionally compelling answers, which are frequently wrong. Chapter 3. Heuristics and the Mind's Shortcuts. Kahneman and Tversky's foundational research established that human judgment under uncertainty relies on a small number of heuristics, mental shortcuts that usually produce approximately correct answers, but systematically fail in predictable circumstances. The most important of these for financial decision-making is representativeness. When assessing the probability that something belongs to a particular category, System 1 asks how similar the thing is to the typical member of that category, how representative it is, rather than asking what the statistical probability actually is. The classic demonstration of this is what Kahneman and Tversky called the conjunction fallacy. They described a person named Linda, young, single, politically active, concerned about social justice, and asked subjects which was more probable, that Linda was a bank teller, or that Linda was a bank teller who was active in the feminist movement. The overwhelming majority of subjects said the second option was more probable. This is statistically impossible. The probability of two events occurring together cannot be higher than the probability of either event occurring alone. But the description of Linda is highly representative of a feminist activist, and adding the feminist element to the bank teller description made it seem more plausible, not less. The representativeness heuristic has direct financial applications. An investor who assesses the quality of a company by how much it resembles a successful company, how good its CEO looks in interviews, how impressive its headquarters, how compelling its story, is using representativeness, not analysis. The resemblance to success is not the same as the probability of success. The availability heuristic is equally important. System 1 estimates probability partly by how easily examples come to mind. Frequent events are easier to recall than rare events. Dramatic events are more memorable than mundane ones. Therefore, we systematically overestimate the probability of things that are dramatic and memorable. Plane crashes, kidnappings, terrorist attacks, and underestimate the probability of things that are common but unmemorable. Car accidents, diabetes, ordinary mismanagement. For investors, the availability heuristic produces overreaction to dramatic recent events. The market crashes that have most recently occurred are highly available mentally and therefore feel more probable to repeat. The long years of steady growth that preceded the crash are less available and feel less representative. Chapter 4. Prospect, Theory and Loss Aversion. Kahneman and Tversky's most important technical contribution to economics was prospect theory, published in a paper in Econometrica in 1979 that has become one of the most cited papers in the history of social science. Prospect theory was developed as an alternative to expected utility theory, the standard economic model of how people make decisions under risk. Expected utility theory said that people choose between risky options by computing the expected utility of each option, probability multiplied by outcome, and selecting the one with the highest expected utility. The theory predicted rational, consistent behavior. The problem was that actual human behavior was neither rational nor consistent in the ways the theory predicted. Kahneman and Tversky documented a series of systematic violations. The most fundamental was loss aversion. People are not symmetric in their responses to gains and losses. They feel the pain of losing a sum of money significantly more intensely than they feel the pleasure of gaining the same sum. Kahneman and Tversky's research suggested that losses feel roughly twice as painful as equivalent gains feel pleasurable. This asymmetry has profound implications for financial behavior. An investor who is loss-averse will hold on to losing investments longer than they should, because selling realizes the loss and makes it psychologically real in a way that holding does not. They will also take less risk than is optimal for their financial situation, because the pain of potential losses outweighs the pleasure of potential gains, even when the expected value calculation favors taking the risk. Loss aversion also explains why investors panic in market downturns. A 10% fall in a portfolio is objectively less significant than a 10% rise is positive. But loss aversion means it feels much worse. The emotional intensity of the loss response overwhelms the rational assessment of whether selling in a downturn is actually the right decision. A second key insight from prospect theory is that people evaluate outcomes relative to a reference point, not in absolute terms. A gain is evaluated as a gain relative to where you started. A loss is evaluated as a loss relative to where you started. But the reference point is not fixed. It changes with experience, and changing it can produce what appear to be inconsistent preferences. Chapter 5. The Weisiati Problem. One of the most important concepts in thinking fast and slow is what Kahneman calls Weisiati. What you see is all there is. System 1 constructs the best possible story from the information available to it. It does not ask whether the information it has is complete. It does not ask what information might be missing. It takes what is there and builds a coherent, confident narrative from it. And that narrative feels true, because System 1's stories always feel true. The Weisiati problem means that the quality of your decisions is not determined by how much information you have in total. It is determined by what information is present in your mind at the moment you make the decision. Information you don't think about doesn't exist from System 1's perspective. Information that is vivid and recent is more influential than information that is statistically more relevant but less immediately present. For investors, Weisiati produces a specific and persistent error, overweighting the most recent past. An investor who has watched a stock rise for 3 years has 3 years of positive evidence prominently available. The business failures and value destructions that preceded the rise, or that happened in similar situations elsewhere, are not prominently available. System 1 builds a story from what it sees. The stock has gone up. The company's story is compelling. The management has been impressive. The story is coherent. The system is confident. The important question, what is this worth, independent of recent price behavior, is the question that is not being asked. Weisiati also explains overconfidence, one of the most well-documented findings in the psychology of expert judgment. Because System 1 builds coherent stories from available information, and because those stories feel true, people are routinely more confident in their judgments than the actual quality of their information justifies. Chapter 6. The Illusion of Skill. One of the most provocative chapters in Thinking Fast and Slow concerns investment skill, and specifically Kahneman's conclusion that for most investment managers, what appears to be skill is actually luck. Kahneman describes an experience early in his career consulting for an investment firm. He was given the annual performance records of 25 individual advisors over 8 years and asked to analyze whether there were patterns of skill, whether some advisors consistently outperformed, and whether their outperformance was correlated with the results of previous years. He ran the correlations. The results were not just disappointing, but shocking. The average correlation between an advisor's performance in 1 year and their performance in the following year was approximately 0.01, essentially zero. There was no consistent pattern of skill. The advisors who did best in 1 year were not the advisors who did best the next year. The firm's compensation system, which rewarded the advisors who outperformed in each year, was therefore rewarding luck, not skill. This finding is consistent with a large body of academic research on active investment management. The majority of actively managed funds underperform their benchmark index over any 10-year period. The minority that outperform in one decade do not reliably continue to outperform in the next. The persistence of investment skill is substantially lower than the investment management industry, which is paid on the premise that skill exists and can be hired, would like investors to believe. Kahneman is not saying that all investment skill is illusory. He acknowledges that in some domains, particularly in corporate finance, private equity, and other areas where genuine information advantages and analytical skills are relevant, skill plays a meaningful role. What he challenges is the widespread assumption that skill is the primary driver of investment performance in liquid public markets, where prices reflect information quickly. Chapter 7. Anchoring. Anchoring is one of the most powerful and most reliably demonstrated biases in human judgment. When making numerical estimates, System 1 is strongly influenced by whatever number has recently been presented, even if that number is known to be arbitrary or irrelevant. The classic demonstration. Spin a wheel of fortune numbered 1/100 in front of experimental subjects. Then ask them what percentage of African countries are in the United Nations. Subjects whose wheel landed on a high number give higher estimates than subjects whose wheel landed on a low number. The spin of a wheel, which subjects know has nothing to do with the question, still significantly influences their answers. For investors, anchoring operates in several important ways. The purchase price anchor. When an investor has bought a stock at a particular price, that price becomes a reference point that influences all subsequent judgments about the stock. If the stock falls below the purchase price, the investor anchors on the loss relative to the purchase price and holds, waiting to get back to even. The purchase price is irrelevant to the stock's current value. What matters is what the stock is worth now and whether it will be worth more or less in the future. But the anchor to the purchase price distorts the analysis. The recent price anchor. When evaluating whether to buy an asset, investors anchor on its recent price. If a stock has recently been at $100 and is now at $80, investors perceive the $80 price as cheap, as a discount, regardless of whether $80 is actually a good price given the stock's fundamentals. The anchor to the recent price substitutes for an independent assessment of value. Anchoring to initial valuations. When analysts and investors form initial views about the value of an asset, those initial views become anchors that subsequent analysis adjusts around rather than replaces. Even when new evidence suggests a dramatically different conclusion, the adjustment from the original anchor tends to be insufficient. Chapter 8. Regression to the mean. One of Kahneman's most useful contributions for practical decision-making is his emphasis on regression to the mean, a statistical phenomenon that is both extremely important and extremely easy to ignore. In any situation where performance is influenced by both skill and luck, extreme performance in one period tends to be followed by more average performance in the next period. This is not because skill has changed. It is because the extreme performance reflects a combination of high skill and high luck, and the luck element does not persist. The best fund manager in any given year is almost always a combination of a good manager and a lucky year. Next year, the skill persists, but the luck is random. It might be good or bad. On average, the performance regresses toward what the skill alone would produce. Regression to the mean has a particular implication that Kahneman found striking. It means that punishment sometimes appears to cause improvement and praise appears to cause deterioration. This is because punishment tends to follow poor performance and praise tends to follow good performance. But poor performance, being partly luck-driven, tends to be followed by better performance regardless of the punishment. And good performance tends to be followed by worse performance regardless of the praise. The regression to the mean is misattributed to the feedback. For investors, regression to the mean means that the best performing investments of the recent past are often not the best investments for the coming period, and the worst performing investments are not necessarily the worst going forward. The extreme performance of recent leaders reflects a mixture of genuine quality and temporary good fortune that will not persist. Chasing recent performance, which is what the vast majority of retail investor fund flows do, is therefore a reliably poor strategy. Chapter 9. The Two Selves. One of the most philosophically interesting sections of Thinking, Fast and Slow deals with what Kahneman calls the two selves, the experiencing self and the remembering self. The experiencing self is the self that lives in the present moment, that experiences pleasure and pain, satisfaction and frustration as they occur. The remembering self is the self that looks back on experiences and constructs a narrative about what they were like. These two selves do not necessarily agree. The experiencing self lives through all the moments. The remembering self summarizes those moments into a story, and the summary is not an accurate average of the experience. It is heavily influenced by two features: the peak, the most intense moment, whether pleasant or unpleasant, and the end, how the experience finished. The duration of an experience, how long it lasted, has remarkably little influence on the remembering self's evaluation of it. This has direct implications for how people think about financial outcomes. The memory of an investment is shaped heavily by its peak performance and its ultimate resolution, not by the day-by-day experience of holding it. An investment that rose dramatically and then fell back to its original value will be remembered as a roller coaster, even if most of the time it was simply hovering near the original price. An investment that generated steady returns for a decade but then dropped sharply at the end will be remembered as disappointing, even if the compound returns were excellent. Understanding the two selves helps explain why investors' memories of their own performance are generally biased in the positive direction. They remember the peaks and the victories more vividly than the duration of the ordinary periods. Chapter 10. The Planning Fallacy. The planning fallacy is Kahneman's term for the systematic tendency of people to underestimate the time, cost, and risk of future actions while simultaneously overestimating the benefits of those actions. This is an extremely well-documented phenomenon. Large construction projects routinely take longer and cost more than planned. Large IT projects routinely take longer and cost more than planned. New products routinely take longer to launch and generate less revenue than planned. The pattern is remarkably consistent across domains. The cause is an inside view problem. Planners focus on the specific case they are planning, the specific project with its specific characteristics and specific plans, and they build their estimates from the inside of that specific case. They do not take the outside view. They do not ask what happens to projects like this one, in general, as a class. When people take the outside view, when they look at the historical record of similar projects, they find a very different picture from the one generated by inside view planning. Most large projects run over time and over budget. Most new products disappoint their initial revenue projections. Most acquisitions fail to create the synergies that were projected. The outside view captures the base rate, what happens in the general case, which the inside view systematically ignores. For investors, the planning fallacy means being skeptical of the projections that accompany investment proposals, whether those are company earnings, forecasts, acquisition synergy projections, or startup revenue models. These projections are almost always inside view constructions that take the specific case at face value rather than calibrating against the outside view base rates of similar situations. Chapter 11. Overconfidence and what to do about it. Overconfidence is the most consistent finding in the psychology of expert judgment. Studies across dozens of domains consistently find that people's confidence in their judgments exceeds the actual accuracy of those judgments. This is true for doctors, lawyers, engineers, investment analysts, meteorologists, and almost every other professional group studied. The calibration problem is particularly severe in investment. Investment analysts produce price targets and earnings forecasts with levels of precision that imply a degree of predictive accuracy that their actual track records do not support. An analyst who says a stock will be worth X dollars in 12 months is providing a point estimate for something that depends on a huge number of uncertain factors. The confidence implied by the precision of the estimate is not justified by the uncertainty of the underlying situation. What can you do about overconfidence in yourself and in the information you rely on? Kahneman's prescription is consistent. Seek the outside view. Before making any significant prediction, look at the historical record of similar predictions in similar circumstances. Before committing to a plan, look at the base rate of similar plans. Before accepting an analyst's price target, look at the track record of similar analysts making similar predictions. The outside view does not replace the inside view. You still need to understand the specific case. But anchoring your confidence to what has actually happened in similar situations, rather than to the compelling specificity of the case in front of you, produces better calibrated judgments. A second prescription is to actively look for disconfirming evidence. Evidence that challenges rather than supports your current view. System 1 has a strong confirmation bias. It seeks and weights information that is consistent with its existing narrative. Deliberately seeking contrary evidence forces System 2 to engage with the alternatives that System 1 is filtering out. Chapter 12. What Kahneman means for your money. The practical implications of Kahneman's work for investors can be summarized in a small number of principles. First, know which decisions you are actually making. Many investment decisions that feel like rational assessments of value are actually emotional responses to recent price movements, vivid stories, or anchors to irrelevant numbers. Before acting, ask whether your decision is based on a genuine assessment of current value and future prospects, or on the feelings generated by System 1. Second, be humble about your ability to identify skill. The evidence is that persistent investment skill in liquid public markets is rarer than the investment management industry acknowledges. Index funds, which do not claim to identify skill but simply capture market returns, outperform the majority of actively managed funds over long periods. This does not mean skill is impossible, but it means the evidence for any specific manager's skill should be substantial before you pay for it. Third, treat losses differently. Loss aversion leads to holding losing positions too long and selling winning positions too early, the exact opposite of what optimal investment strategy prescribes. When a position is losing, the relevant question is not whether it is below your purchase price, which is irrelevant to its future prospects, but whether it is a better use of your capital than the alternatives. Fourth, beware of the narrative. System 1 loves stories. Compelling narratives about companies, industries, and economic trends feel true in a way that dry statistical analysis does not. But the compelling narrative is often a Wysiati artifact, a coherent story built from available information that ignores all the relevant information that is not available. Chapter 13. The slow systems advantage. If System 1 is so unreliable, why don't we just use System 2 all the time? The answer is that System 2 is expensive. It requires mental energy that is limited. It can only handle one thing at a time. And it is slow in a world where many decisions need to be made quickly. But in domains where decision quality matters more than decision speed, and investment is one of those domains, the deliberate, systematic use of System 2 produces better outcomes than trusting System 1's intuitions. The disciplines that force System 2 engagement include written investment theses that require articulating the reasons for a decision, pre-mortems that ask what would need to be true for this decision to fail, checklists that ensure relevant factors are not omitted, waiting periods that separate the impulse to act from the actual decision, and active searches for disconfirming information. None of these disciplines guarantee correct decisions. Markets are too complex and too uncertain for anyone to be right consistently. What they do is reduce the frequency of the most predictable errors, the ones that Kahneman spent his career documenting. Chapter 14. The lasting contribution. Daniel Kahneman spent his career asking a simple question: why do smart people make predictable mistakes? His answer, that human cognition has two modes, one fast and emotionally compelling, and one slow and effortful, and that the fast mode is wrong in predictable ways about probabilistic questions, was not a comfortable answer. It implied that education and intelligence are not reliable protection against the biases that drive poor decision-making. The comfort in Kahneman's work is not in the idea that the biases can be eliminated. They cannot, but they can be recognized. And what can be recognized can sometimes be resisted. Not always, not reliably, but sometimes in the moments when the decision is important enough to slow down and ask whether the confidence system one is providing is actually justified by the evidence. That's the practice Kahneman was pointing toward. Not the elimination of System 1, which is impossible, but the deliberate, habitual engagement of System 2 in the decisions where the stakes are high enough to warrant the effort. Thinking, Fast and Slow is a book that changed how millions of people understand their own minds. Its application to investment is direct and practical, but its deeper contribution is simpler, a more honest account of what we are and what that means for the decisions we make. Remember, this is for educational and informational purposes only and does not constitute financial advice. The ideas here are presented in original language for educational discussion of Kahneman's publicly expressed and published work.